Thanks for joining us on lunch. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Meera Dugal. Let's get to the headlines. Indian equities are unable to hold on to morning gains and are headed for the worst three-month period since 2016.
India's GDP growth is expected to slow down further to 5.7% in the first quarter, according to a Bloomberg poll.
Reserve Bank of India's annual income more than doubled in the year ended June 2019 thanks to larger open market operations and an accounting change on forex gains.
Hindalco subsidiary Novelis gets approval from the European Union regulators for $2.6 billion Alaris deal. That's a report from Reuters.
Let's first take a look at how markets are faring. Yatin is here with us. Afternoon, Yatin.
Afternoon, Neera. And, after having a strong start of 40 points plus on the Nifty, we are right now down at the lowest point in day, almost 25 points down on the Nifty. We are trading in a range-bound manner today. The Nifty Bank also is witnessing, a cut of nearly 0.2% right now. In terms of the Nifty 50 advance decline ratio, not much of activity there, 2 advances to every 3 declines. In fact, if you look at the gainers list, only metals are dominating the entire gaining list. So we have the likes of Vedanta, Tata Steel, Hindalco, which were quite weak for the last 2-3 trading sessions, have witnessed some bounce back, 2-2.5% up for each of them. Z also, after the SL Group announced the divestment of their solar units, is in focus. So that stock is up 1.5% on good volumes of over 30 lakh shares on the National Stock Exchange. In terms of losers, we have Power Grid, Infratel, Coal India and SBI. All of these stocks down anywhere between 2.5% to 3.5%. There have been talks in the marketplace regarding a Bharat 22 ETF, post which we are looking at some kind of pressure that is building on the PSU stocks according to the dealing room checks. As far as active securities are concerned, Indiabulls Housing Finance continues to struggle, 2% down for that one. In fact, the future and option segment is witnessing some large activity in the Indiabulls Housing segment. The futures for Indiabulls Housing, the September series is at a 10% discount to the spot prices. So clearly there is some fresh shorting which is happening in as far as Indiabulls Housing Finance is concerned. Axis Bank is down 2% and so is the case with SBI, which is witnessing a 2.5% cut.
Thanks for that. Get some more quality on this, on how the markets have been faring. The equities are set for their worst 3-month period since March 2016. Take a look at this chart. Analysts don't see a reversal anytime soon. The Nifty has tumbled 8.4% since the end of May. Amidst a slowing economy and a sentiment of risk aversion in emerging markets, foreigners have already pulled out $3.8 billion from the Indian stock market.
That has not turned yet. Meanwhile, the Reserve Bank of India's decision to transfer 1.76 lakh crore to the government has raised eyebrows over the past few days. The FY19 annual report, which came out on Thursday, shed some light on why this transfer actually took place or how it took place. Vishnath Nair explains.
Now, in the last few days, there has been a lot of debate about this 1.76 lakh crore worth of surplus that the Reserve Bank of India is transferring to the government. And there has been a lot of questions. There have been a lot of questions about how exactly the RBI arrived at that such a large amount. Now that the Reserve Bank of India has released its annual report for the financial year ended June 30, 2019, we have a fair understanding on where that money came from. And just the first look at the RBI's annual report would tell you that its annual income for the financial year 2019 came up to 1.93 lakh crore, and that is more than double of what it made in FY18. So obviously that is a large increase in its annual income that has helped the RBI transfer a large amount of surplus to the government. How exactly this 1.93 lakh crore number comes, for that we have to look at each individual items, and just to get a sense of it, most of this increase has come because the other income for the Reserve Bank of India has gone up. So let's look at some of the components of the total income that have contributed in this increase. So firstly is the additional interest income of about 33,000 odd crore. That has come primarily because the RBI conducted a lot of open market operations during this financial year in FY19, and because of that it accumulated a lot of government securities, and thereby there has been an increase in the interest income that it has earned. Second, and probably the more important component of the entire annual income is the revaluation gain on the foreign exchange that the RBI holds, and that has come up to about 29,000 crore. So just to get a sense of how exactly this happened, the Reserve Bank of India moved to the weighted average cost model of valuing its foreign exchange reserves. Earlier, it was looking at it on a weekly basis. Now, this weighted average cost model, according to the Reserve Bank of India, had a net impact of about 21,000 odd crores. So that is why the total gains from the foreign exchange reserves came up to about 29,000 crore. The next important item is also the contingency write back. Now, as part of its assessment of the RBI's economic capital framework, the Bimal Jalan committee had suggested that the RBI is holding excess provisions, and therefore probably some of those provisions can be written back. So that 52,618 crore has been that contingency write back that the Reserve Bank of India has done in FY19, which obviously added to the surplus. The other additional sources have added about 11,000 odd crore, but obviously some of the top three are the more important components of the overall income, which has helped the RBI not only increase its income but also then transfer more money to the government. Now that there has been some kind of revaluation as well as some reassessment of the RBI's reserves, let's look at where exactly these reserves stand. So the contingency fund, remember that we told you there was some write back in the provisions, so that has come down from 2.3 lakh crore to about 1.96 lakh crore as a direct result of that write back of provisions. The next and probably the more important sort of reserve to look at is the currency and gold revaluation account. So that, if you remember what I told you earlier about the weighted average cost model, because of that, the overall balance in the CGRA has come down from 6.9 lakh crore to 6.64 lakh crore. So obviously, all of this is adding into that additional income that the Reserve Bank of India has made during this financial year, and thereby to the actual surplus that it is transferring to the government.
Krishna, thanks for that. India's growth rate is expected to moderate further in the first quarter. A Bloomberg poll of 30 economists have pegged GDP growth at 5.7%. That's a drop from the last reading of 5.8. Pallavi Nahata is standing by on to what will be on these numbers. Pallavi.
A majority of high-frequency indicators and quarter-end corporate commentary indicate that economic growth may have weakened further in the April to June 2019 quarter. GDP growth is expected to fall to 5.7% from 8% an year ago, according to a Bloomberg poll of 38 economists. The growth rate in the fourth quarter of the last financial year stood at 5.8%. If growth remains below 6% in Q1, it will be the first time since 2013 that India has seen 2 consecutive quarters of sub-6% growth. Gross value added is estimated to grow by 5.5% in Q1 from 5.7% in Q4 of FY19. This was according to 27 economists polled by Bloomberg. GVA strips out the impact of indirect taxes and subsidies, providing a better indicator of underlying economic trends. Emerging trends indicate that consumption that's driven economic growth in recent years is weakening. Consumption growth in Q4 FY19 stood at 7.2% compared to 8.4% in the preceding 3-month period. Since then, output of discretionary consumption items such as cars has declined further. Quarterly earnings data from consumer staples companies has also shown weaker volume growth. Should consumption growth slacken, hopes of private investments picking up will also dim further. A recent survey from the RBI showed that seasonally adjusted capacity utilization fell 1.1 percentage points to 74.5% in Q4 FY19. Weak demand can lead to capacity utilization falling further. Moving on to industry trends, economists expect some improvement in manufacturing growth compared to last quarter when growth fell to 3.1%. The index of industrial production grew at a slightly faster pace in the April-June period compared to the 3 months prior. This could imply slightly stronger growth for manufacturing. Electricity growth could support overall industrial growth further, while weakness in construction may pull it down. While services may see slower growth, agriculture is likely to pick up.
All right, that comes out later in the evening today. But what's led through the slowdown and what should we look out for specifically in this time around's data release? Let's go across to Soumyakanti Ghosh, Chief Economist at State Bank of India. Thank you so much, sir, for joining us. Let me start with today's number. What specifically will you be watching for and what's your estimate?
See, we are looking at a number of around 5.6%, but any number between 5.5 to 5.6% is what we are estimating for Q1.
Okay.
And the things, as you asked, which we are looking for, definitely we are going to look into this PFCA, private final consumption expenditure trends, because if I look into that data at constant prices, that has been showing a continuous dip from 9.8%, I think, to 7.2% last quarter. So how that has fared, that is one point. The second point is obviously the numbers on the agricultural sector, because the first quarter, the agricultural sector numbers are always a little weak. And of course, the numbers of the services sector, because that will indicate whether there was the impact of the slowdown was felt across the sectors in Q1.
Okay. Mr. Ghosh, yesterday in the RBI's annual report, we got some analysis from the central bank also on what they think is happening. I think their analysis was that this was a soft spot in the economy, which then went into a cyclical downturn. But there are structural undertones to it as well. And it seems like, while they didn't say it, they seem to believe that there won't be any sharp recovery. Would that match your view?
Yes, of course. I think we are also of the same view, and we think that the second quarter GDP numbers could be actually a little bit better than the first quarter. But from here on, all the estimates as we are seeing right now is primarily because of an better base effects and not because of something else. So in our sense, I think the RBI estimates, as we have said earlier, is possibly a little bit on the upside, and will not be surprised if the growth rate goes much below 6.5%.
How do you anticipate the Reserve Bank of India to be responding to this, Mr. Ghosh? Whether, if this is going to be a beginning of a deep-rooted slowdown, what do you anticipate the MPC to do?
See, we are estimating a terminal reported at 5% throughout the year. So whether it could be 2 rate cuts or it could be 1 rate cut, so that's a matter difficult to conjecture as of now, given that rate cuts are of odd magnitudes. But I will not be surprised if there is, because I have not ruled out an outside probability of the reported going below 5%, but as of now we are holding it at 5% for the rest of the current fiscal year.
All right, Mr. Ghosh, thank you so much for taking a few minutes to explain to us what we should watch out for when we get that all-important GDP number today. August is expected to be no different for automakers, with all the players set to report lower sales numbers for the month, and high base is only going to make it worse for the larger players like Maruti and Tata Motors. Yatin is here to take us through the Bloomberg Quint brokerage poll.
Well, Ira, if you look at the entire month of August, we haven't seen much of a recovery from the previous months. In fact, if you look at most of these passenger vehicle players, they're expected to see a sharp double-digit decline in the overall sales volume. In fact, if you look at for Maruti, which is the market leader in the passenger vehicle segment, we could see a strong, 26-27% kind of a decline, which is possible here. Tata Motors, of course, partially due to the commercial vehicle segment, as well as because of the weakness in the passenger vehicle segment, could see a steep 40% decline on a year-on-year basis. And similar will be the case with companies like Mahindra and Mahindra, the automotive segment, wherein a double-digit decline is expected. Coming to the two-wheeler space, there also we are looking at some problems. The wholesales would be lower this time, since companies are looking to get rid of their overall inventory. So be it Hero MotoCorp or be it Eicher Motors, we will see a double-digit decline coming in there. The only outperform in the pack relatively would be Bajaj Auto, wherein we are expecting a 9% decline to come in on a year-on-year basis. Of course, the export markets is something which needs to be watched out for in terms of the performance, because there is some kind of a fillip which could be seen as far as that segment is concerned. And of course, for the tractor segment also, the things would be flattish. Of course, August seasonally is not a great month for the tractor business. So things for Mahindra and Mahindra, the tractor segment, as well as Escorts, would be flattish, given the fact that there is not much of an activity or a pickup which is seen in that segment as well.
Rathan, thank you for that. Regulators of the European Union is said to have given a green signal to the Novelis-Aleris deal. That's according to Reuters. Remember, Hindalco's American subsidiary is set to secure approval to acquire Novelis and will do so by laying out a proposal before the European Competition Commission. Nikki is standing by with some details on this one.
Yeah, Harsha, looks like there's a light at the end of the tunnel, at least for Hindalco, on account of which we're seeing a 2% uptick on the stock. Given what we saw with Tata Steel and Thyssen Group, we were uncertain as to this deal will go through, but then clearly as to what Reuters reports have suggested, Hindalco's US subsidiary Novelis is set to secure the EU antitrust approval for a $2.6 billion bid for Aleris, and this has come after a lot of concession and the agreement that have gone behind the two parties. Earlier, Novelis just suggested some amount of capacity addition and jobs for that plan, but then EU had an upper hand and has a far-reaching package of concession where it asked for a certain amount of selling off of Aleris Belgian plant. So that's one thing that needs to be kept in mind while looking at this deal and the valuation. However, the final decision from the Commission is expected to take place by October 7, 2019. What Hindalco to us suggested earlier that the deal is expected to be completed by Q4 of this calendar year as compared to Q3 previously on account of regulatory hurdles obviously that the company has been witnessing. Just to give a little basic details of when the deal was signed, it was back in July 2018 that the deal was signed. It was expected to be funded by both debt as well as equity way of funding, and the synergy for that matter, that's to the extent of $150 million, which is expected to be realized in the span of 3 years of operation coming in from Aleris. Now, Aleris typically has been doing well, and if you look at the Q2 results that the company has posted, looks like the target of $360 million that the company had set out going to be surpassing that. But then there is a little contra view coming in from Phillip Capital, who has suggested that one needs to, while this is a long-term bet for Hindalco, but then in short run, this is definitely increase the debt for Hindalco, and that comes at a time when we're looking at a trade war situation. And also the Belgium plant, for that matter, that is relatively big and would have some amount of bearing or would change the EBITDA estimates of Aleris of $360 million that it otherwise planned to achieve by calendar year 2021.
Nikki, thanks so much for that. This year has not been too kind to equity investors with a host of issues plaguing the market. Would one stand to make more by turning to stocks that pay a handsome dividend? And if so, which ones? Samit Sarkar has the answer.
So I'll start off with the top 10 companies that have seen an highest dividend yield in financial year 2019. Firstly, what is a dividend yield? Dividend yield is the ratio of the company's annual dividend compared to its share price. Now, this dividend yield can be higher for a company also if the share price has seen a significant drop. So this does not mean that investing in these companies might have given investors great returns, but at least because of higher dividends, they might have got at least some assured returns in investing in these stocks. So I start off with the list. Nalco tops the list with a dividend yield of close to 15.1%, Vedanta 14.6%, SJVN, that is Satluj Jal Vidyut Nigam 9%, NLC India 8.4%, REC close to 8%. Another on the next 5 there is Indian Oil Corporation, National Fertilizer, Coal India, Oil India and HPCL, but the dividend yield has been in the range of around 7 to 8%. As you can see in the top 10 list, nearly 9 of them are government owned companies, while there's only one private company, that is Vedanta, which has been there on the list and is second on the list. So I'll start off with Nalco, which is the government owned and the highest dividend yield company. Now in FY19, the company gave a dividend of per share of close to 5.75 rupees, which was the highest in the last 11 years. As you can see, in financial year 2008, the company had declared a dividend of 7 rupees. Post that, this is the highest dividend given by the company, and this is after a buyback of close to 500 crore rupees done by the company in November 2018. Now, Vedanta, which is the only private company, comes on the list and is the second highest dividend and has the second highest dividend yield, and that is because of a fall in share prices. As you can see, the dividend per share for the company was around 19 rupees per share in FY19, which was the lowest in at least the last 3 years, but its dividend yield was highest because of the fall in share prices that we had seen earlier for Vedanta. Third on the list is SJVN. Now, the company has a healthy track record where it has been giving a dividend of close to 1 to 3 rupees per share. As you can see, FY16, the dividend per share was 1.1 rupees and it increased to 2.75, and it has been around in the range of 2 rupees per share in the last 2 financial years. So that's how, and this is also after a buyback of around 800 crore rupees that the company had done last year. That the company has announced a dividend of close to 2 rupees in financial year 2019. Fourth on the list is NLC India, has been consistently rewarding shareholders, but as you can see here, the payout has seen a bump up from FY17, but this could be because of the government's aim to meet its disinvestment target. As you can see, in FY17, the company did a dividend of close to 7.4 rupees per share, which then fell to around 4.5, but then again has been remained stable at close to 4.5 rupees per share. Fifth on the list is REC, where the company has been again continuously paying dividends, and 11 rupees dividend in financial year 2019, which is the highest in at least the last 6 years. As you can see, from FY14 to FY18, the dividend has been in the range of around 5 to 9 rupees, but in FY19, the company gave a dividend per share of 11 rupees per share. Then also we have Indian Oil Corporation, HPCL, Oil India in this list. Of Indian Oil Corporation, FY19 was the year when it gave its shareholders the highest ever payout. There was a buyback of close to 3,400 crore rupees, also a dividend of close to 18 rupees per share. So Indian Oil Corporation was also part of that list, which has seen a highest payout to shareholders in the financial year 2019.
Samir, thanks for that. Elon Musk and Jack Ma shared the stage for the first time yesterday, and they didn't disappoint. At the World Artificial Intelligence Conference in China, the debate between China's richest man and Tesla's boss left a largely Chinese audience awestruck. The two sparred over everything from the existence of aliens to the preservation of human consciousness. Take a look.
I think the Tesla China team has done an amazing job, really mind-blowing. Like, I'm just astounded by how good the job is and how much progress has been made. So, I think it's like, I really think China is the future. That's very impressive.
I think people should work 3 days a week, 4 hours a day. When we have electricity, the power of electricity is that we make people more time. So you can go to the karaoke in the evening, you can go to dancing party in the evening. So people, because of electricity, people have more time. I think because of artificial intelligence, people will have more time enjoy being human beings.
No single country has all the resources, technologies, and the capabilities it needs to conduct the next technology wave. There are now trade and geopolitical frictions. We have to have a big heart to overcome all these barriers.
Out of time on the show. Thank you so much for watching us.